Though the Fed did its best to reassure investors, bond yields still rose last week following March's meeting. Matters weren't helped by the announcement that the Federal Reserve would be allowing the pandemic prompted changes to the supplementary leverage ratio for banks to expire at the end of the month. The reversion to the old rules means the relevant financial institutions will once again have to include holdings of US Treasuries and cash kept in reserve at the Fed when calculating the SLR ratio, which means banks could start to once again sell their Treasury notes, as was seen pre-pandemic last year, or at the start of the pandemic last year, potentially pushing bond yields even higher. How will Central Bank Jerome Powell handle this issue then in his multiple appearances this week? Jay's a busy boy. On Monday, he is due to participate in a virtual panel hosted by the Bank for International Settlements, while on Tuesday and Wednesday he testifies alongside Treasury Secretary Janet Yellen and obviously former Fed Chair Janet Yellen in front of the House Financial Services Committee and the Senate Banking Committee, respectively. Appropriate levels of monetary policy in the face of a rebounding economy, the tolerance of inflation beyond the 2% target, and the pesky question of falling bond prices and rising yields are all likely to come up. And Powell's answers could have a big impact on how the markets ride out the final full week of March. Beyond Powell's many appearances, there are a few key pieces of data this week. Monday's existing home sales reading is set to fall from 6.69 million to 6.55 million, while the new home sales reading on Tuesday is expected to also be down from 923,000 to 880,000. On Wednesday, things should look a bit better. The flash manufacturing PMI for March is set to rise from 58.6 to 59.6 month on month, with its services equivalent creeping up from 59.8 to 60.1. The final Q4 GDP reading on Thursday isn't forecast to change, holding at that 4.1% growth at the annualized rate. But after expectedly climbing last week, the usual Thursday jobless claims number is set to retreat once again from 770,000 to 737,000. A bumper day for data on Friday is then forecast to see a sharp reversal in personal income and personal spending from 10% to minus 6.9% and from 2.4% to minus 0.8% respectively. Revised consumer sentiment, on the other hand, is looking to increase from 83.0 to 83.6. Finally, and arguably the most important piece of data this week, the core PCE price index is set to fall from 0.3% to 0.1%. The figure is a favourite of the Fed, and the US inflation readings are only going to become more and more relevant as the months go on and the American Rescue Plan kicks in. So there could be some interest in how this early number pans out. And if it does fall as expected from 0.3% to 0.1%, that could help out the markets towards the end of the week. As mentioned, however, it is looking like another potentially bond yield heavy, inflation heavy, central bank heavy week, with Powell's comments in the first half of the week potentially setting the tone for trading and setting the path for whether or not the Dow Jones can get back to 33,000 and those all-time highs seen recently, or whether its decline that set in at the end of last week will become a bit more of a permanent feature for the Dow Jones heading into the final few days of March and the start of April next week.